Preparing for a financial analyst at SPAR interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through how you would analyze SPAR's monthly financial performance. I would begin with the income statement, balance sheet, and cash flow statement, comparing actual results against budget, forecast, and the prior year. For SPAR, I would examine revenue by client, service line, or geography, then review labor, travel, subcontractor, and overhead costs. I would quantify each variance, distinguish timing from structural issues, validate unusual movements with operational teams, and finish with actions, risks, and an updated outlook rather than simply reporting historical numbers. While answering, focus on comparing actual results with budget, prior periods, and forecast, separating revenue, cost, volume, and timing drivers, investigating material variances, and summarizing implications clearly for management. Question 2. Which KPIs would you monitor for a merchandising and retail services business like SPAR? I would combine financial and operating KPIs. Financial measures would include revenue growth, gross margin, EBITDA margin, operating cash flow, receivable days, and client or project profitability. Operationally, I would track store visits completed, hours per visit, productivity, compliance scores, and service level performance. The key is connecting them. Declining visit productivity may pressure margins before it appears in reported earnings, while slower collections can create a cash problem despite strong revenue growth. Make sure to cover revenue growth, gross margin, labor productivity, project or client profitability, utilization, accounts receivable days, cash conversion, and operational measures such as store visits, compliance, and completion rates. Question 3. How do the three financial statements connect? Net income begins on the income statement and increases retained earnings within equity. The cash flow statement adjusts net income for non-cash items, such as depreciation, and working capital movements to derive operating cash flow. Capital expenditures increase property and equipment on the balance sheet and reduce investing cash flow. Debt or equity financing changes liabilities or equity and cash. Ultimately, ending cash from the cash flow statement must equal balance sheet cash. In your answer, talk about net income flowing into retained earnings and operating cash flow, depreciation linking income and assets, working capital movements affecting cash, and ending cash reconciling through the balance sheet. Question 4. A region is 8% below revenue budget but labor costs are 5% above budget. How would you investigate? I would first confirm the data, period, and budget basis. Then I would separate the revenue shortfall into client volume, pricing, project timing, and mix. For labor, I would analyze hours, rates, overtime, staffing levels, and productivity against completed work. Perhaps projects were delayed while employees remained scheduled. I would discuss the evidence with regional operations, quantify the full-year impact, and recommend staffing adjustments, recovery actions, or a revised forecast. Be sure to mention decomposing the variance into volume, price, mix, productivity, and timing, checking staffing and contract assumptions, testing data quality, and translating findings into corrective actions and forecast changes. Question 5. How would you build a forecast for SPAR's revenue? I would build revenue from operational drivers rather than applying a blanket growth rate. That could include client contracts, expected store visits, service rates, project timing, seasonality, renewal assumptions, and weighted pipeline opportunities. I would reconcile the bottom-up forecast to historical trends and management targets, document assumptions, and create base, upside, and downside cases. Monthly actuals would refresh the model, allowing forecast error to improve through an explicit variance feedback process. Focus on using a driver-based model built from clients, contracts, store or project volumes, service rates, staffing capacity, seasonality, renewals, pipeline probability, and explicit assumptions that can be challenged. Question 6. What is the difference between a budget, forecast, and variance analysis? A budget is the approved financial plan established before or at the start of a period. A forecast is management's latest estimate of what will actually happen, incorporating new information. Variance analysis explains why actual results differ from budget, forecast, or prior periods. I would not stop at saying revenue was unfavorable. I would identify whether the cause was lost volume, delayed work, lower pricing, customer mix, or an accounting timing issue. While answering, distinguish the budget as an approved plan, the forecast as the latest expected outcome, and variance analysis as the explanation of differences, including both financial results and operational drivers. Question 7. How would you assess the profitability of a client or project? I would start with recognized revenue and the contract's billing terms, then assign direct labor, travel, subcontractor, technology, and other project costs. I would calculate gross or contribution margin before considering a reasonable overhead allocation. I would also compare budgeted economics with actual hours, rates, scope changes, and collections. A project may show accounting profit but consume cash or management capacity, so I would include backlog quality, renewal potential, and execution risk. In your answer, cover revenue recognition, direct labor, travel, subcontractors, pass-through costs, allocated overhead, contribution margin, contract terms, cash collection, and whether reported profitability reflects sustainable economics. Question 8. What Excel tools would you use to analyze a large operational dataset? I would first standardize fields, remove duplicates, and validate dates, entities, and amounts. For analysis, I would use structured tables, SUMIFs, XLOOKUP, pivot tables, and conditional formatting. Power Query would help automate recurring data preparation, while simple control totals would confirm that transformed data ties to the source. I would separate raw data, calculations, assumptions, and outputs, protect key formulas, and document the workflow so another analyst can reproduce it. Mention data validation, structured tables, XLOOKUP or index match, SUMIFs, pivot tables, Power Query, error checks, scenario controls, and clear documentation. Emphasize accuracy and repeatability over flashy formulas. Question 9. How would you improve the reliability of a management reporting pack? I would establish one source for each metric and define ownership, calculation logic, and reporting frequency. Every pack should reconcile key figures to the general ledger or approved operational systems, with checks for completeness, period cutoffs, and prior period anomalies. I would automate repeatable schedules where practical, use variance thresholds to focus review, and maintain version control. Finally, commentary should explain drivers, risks, and actions, not merely restate the numbers. Make sure to cover standardized definitions, reconciliations to the general ledger, controlled source data, variance thresholds, review procedures, version control, and concise commentary focused on decisions rather than excessive detail. Question 10. Explain working capital and how it could affect SPAR's cash flow. Working capital measures cash tied up in operating assets and liabilities, commonly receivables, payables, and accrued expenses. If SPAR records revenue for completed services but customers pay later, receivables rise and operating cash flow falls. I would monitor aging, billing delays, disputes, unbilled work, collection trends, and payment terms. Stronger invoicing discipline, earlier dispute resolution, and appropriate supplier terms can improve cash without reducing service quality or reported revenue. Focus on receivables, payables, accrued expenses, and contract timing. Explain that revenue growth can consume cash when collections lag, and discuss aging analysis, billing discipline, and supplier terms. Question 11. How would you evaluate a proposed investment in technology or field operations? I would define the decision and compare incremental cash flows with a realistic do-nothing case. Benefits might include lower administrative hours, better field productivity, fewer errors, stronger client retention, or additional capacity. Costs would include implementation, training, licenses, integration, and disruption. I would calculate payback, NPV, and IRR, then test adoption, savings realization, timing, and terminal assumptions. I would also assess data security, scalability, and operational readiness before recommending approval. Be sure to mention incremental cash flows, implementation costs, labor savings, revenue or quality benefits, working capital, payback, NPV, IRR, sensitivity analysis, and non-financial execution risks. Question 12. How do you distinguish a temporary variance from a structural problem? I would examine the variance across several periods and reconcile it to operational events. A delayed client launch, annual bonus, or unusual repair may be temporary, while sustained productivity declines, pricing pressure, or contract loss is structural. I would normalize one-time items, compare affected units with peers, and speak with the responsible teams. The forecast should reflect the conclusion. Temporary issues require timing adjustments, whereas structural issues need revised assumptions and corrective plans. In your answer, discuss period timing, one-time items, recurring trends, operational evidence, contract changes, benchmarking, and whether the issue persists after normalization or appears across multiple reporting periods. Question 13. Describe your approach to revenue recognition for service contracts. I would review the contract to identify promised services, performance obligations, pricing, milestones, acceptance terms, and variable consideration. If SPAR provides recurring field services over time, revenue may be recognized as performance occurs, supported by completed work and reliable measurement. For milestone-based projects, recognition depends on whether the milestone represents transferred value and applicable accounting guidance. I would ensure cutoffs, accruals, contract modifications, and judgments are documented and consistently applied. Focus on identifying performance obligations, determining whether services are delivered over time or at a point in time, matching revenue with performance, handling variable consideration, and documenting judgments under applicable standards. Question 14. What steps would you take if actual results did not reconcile to the reporting system? I would preserve the original reports and identify the exact point where totals diverge. Then I would check period filters, entity mappings, currencies, account classifications, duplicates, missing records, intercompany eliminations, and interface timing. I would reconcile control totals back to the general ledger and source systems, involving accounting or IT when needed. I would not force the numbers to tie. I would document the root cause, correction, and any control improvement. Mention preserving the original data, checking mappings, dates, currencies, eliminations, duplicate or missing records, system interfaces, and control totals. Escalate material unexplained differences promptly and transparently. Question 15. Tell me about a time you communicated difficult financial information to a non-finance stakeholder. In a prior analysis, I found that a project was materially below margin expectations because hours exceeded the original staffing assumption. I avoided accounting jargon and showed the manager three numbers: planned hours, actual hours, and the margin impact. I asked whether scope or execution caused the difference, then agreed on approval controls for additional work. The conversation remained constructive because I focused on facts, operational causes, and a practical solution rather than assigning blame. Make sure to cover simplifying the message, using operational language, separating facts from assumptions, explaining business impact, listening to the stakeholder, and agreeing on specific next actions and ownership. Question 16. How would you handle conflicting priorities during month-end close? I would list deliverables by deadline, financial materiality, and dependency, then confirm priorities with my manager and the close calendar owner. I would complete reconciliations and close critical schedules first, communicate realistic timing, and escalate conflicts before deadlines are missed. Where possible, I would use standardized templates and parallelize data gathering. I would avoid sacrificing control quality for speed. Lower priority commentary can wait, but unsupported journal entries or unreconciled balances cannot. In your answer, discuss materiality, deadlines, dependencies, stakeholder communication, a visible task list, early escalation, and protecting accuracy for close critical work while deferring lower value analysis. Question 17. What controls would you expect around payroll, labor, and field service costs? I would expect employees or contractors to record time against approved jobs, with supervisor review before payroll or invoicing. Key controls include role-based access, segregation between time entry and approval, validated pay rates, duplicate and exception reports, and reconciliation from time records to payroll and the general ledger. I would investigate unusual overtime, inactive personnel, missing approvals, and costs charged to closed projects. These controls protect both margin reporting and client billing accuracy. Focus on approved schedules, time capture, supervisor authorization, segregation of duties, exception reporting, duplicate checks, rate validation, reconciliation to payroll, and monitoring unusual overtime or inactive employees. Question 18. How would you model a downside scenario for SPAR? I would start with a clearly defined shock, such as a major client reduction, lower store activity, wage inflation, or delayed project launches. I would model the direct revenue effect, realistic cost flexibility, staffing implications, receivables timing, and one-time mitigation costs. Then I would show impacts on EBITDA, operating cash flow, liquidity, and key thresholds. I would pair the downside with early warning indicators and actions, such as redeploying labor, controlling hiring, or renegotiating scope. Be sure to include plausible operational shocks such as client loss, lower store activity, wage inflation, or delayed projects. Flex costs realistically, and show effects on revenue, margin, cash, covenants, and management actions. Question 19. What would you do if a manager asked you to adjust an analysis to make performance look better? I would first clarify whether the request concerns a legitimate correction, such as removing a non-recurring item, or a misleading presentation. I would keep the underlying data intact and show any adjusted view separately, with a clear definition and reconciliation to reported results. If the change obscured material information, I would explain the risk, document the discussion, and escalate through the appropriate finance or ethics channel. Credibility is more valuable than a favorable short-term narrative. Mention protecting data integrity, clarifying legitimate accounting or presentation issues, refusing misleading changes, documenting assumptions, escalating appropriately, and offering a transparent alternative with clearly labeled sensitivities. Question 20. What would your priorities be in your first 90 days as a financial analyst at SPAR? My first priority would be understanding SPAR's service model, major clients, reporting structure, systems, close calendar, and key operating drivers. I would shadow accounting and regional operations to learn how field activity becomes revenue and cost. Next, I would validate recurring reports, identify manual steps or reconciliation gaps, and deliver a focused improvement, such as an automated variance schedule. By day 90, I would aim to provide reliable analysis, communicate clearly, and have a documented development plan. Focus on learning business drivers, systems, reporting calendars, client and regional economics, control requirements, stakeholder relationships, and delivering one practical improvement while building trust through accurate, timely work. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.